Welcome back to another week of the Educated Homebuyer Live with Josh and myself here to update you on the economy, what's happening with the Fed, mortgage rates, everything housing, and answer your mortgage questions, your real estate questions. That's why we're here, is to help you guys become the educated homebuyers. So Josh, today got a little bit of news from the Fed, some positive news, kind of reading between the lines, and we'll talk a little bit more about that as we dive into the details. But on the surface, things are looking better as far as the direction of mortgage rates.
Absolutely. And we have some really good data in here to go through. But it basically fell in line with what we were expecting. They're still data dependent. They're telling us what the data is. We know it's inflation continuing to moderate. It's the job market, moderation in the job market. They don't want weakness in the job market. They just don't want a hot jobs market. So we've got lots of slides with lots of data to walk right through it.
Now, before we do that, I'd like to take a minute and ask you, if you have questions tonight, start putting them in the chat. We're going to go through some slides. There's a lot of slides here. We're going to look at inventory. We're going to look at inflation. We're going to get through these as quickly as possible, but it's really easy for us to come out of that and to jump into questions if they're already in there. So if you're in here tonight watching, you have questions about what's happening, start putting them in the chat now. And also let us know who's watching. I know Willing's here. Who else is here? Let us know where you're watching from. We want to give you a shout out and keep you guys engaged. And also thank you for being here. So Josh, let's start as we always do and take a look at inventory. So I am once again not ready, like always, to talk about inventory, but we're going to do it anyway.
Well,
so
while you're pulling up your data,
yeah.
Jeb, speaking of asking where you guys are at, this week, very fortunate, we had a new purchase in Texas that came through for a veteran listener of the show, and a new purchase in North Carolina. We always talk about, terms should be from a reputable lender within a fairly narrow range of terms. For whatever reason, this lender had good terms on the 30-year, and they weren't competitive on the 15. We were actually able to save them about 0.5% in interest versus what they were being quoted.
And you also had Nevada. Don't forget about Nevada. Nevada showed up as well.
Yes, we have a listener who another veteran, and we love helping all listeners, all viewers, but especially veterans. I wasn't able to serve. I went a different direction. So be able to give back people who have served the country is definitely a pleasure. Jeb, no one can hear you. No one can hear you.
Well, it's because mute is on. Because my mute is on.
Jeb, the best part is I thought it was me, and I'm sitting here going, "Oh, so I did something wrong. I can't hear Jeb." So I was waiting for them to pipe up. And
how much of that didn't we hear? Did we not hear anything? Josh, help me out. Josh, hello.
Yep.
What's the last thing you heard?
We didn't hear anything.
You didn't hear anything.
When you came into the very first slide is when it went silent.
Got it. All right. So 677,000 single family homes nationwide. That's up 1.3% week over week. It's the highest level that we've seen. You can see going back since basically early or latter part of early part of 2020 rather. So we're at the peak of inventory that we've seen in the last 4 years. Orange County sitting at 3,350, so 3,350 homes. We were just over 3,300 last week. That's a 1.46% increase week over week. Huntington Beach sitting at 221 homes. That's up 8% week over week. And that's, Huntington, we were just over 200 homes last week. So a little bit of context there. I threw this chart in here this week. This is going back to June. So we're coming out of July. So this is about a month old, but I found this chart interesting. This is for Orange County. Just shows, almost a third of the properties that sold in June were cash buyers. It's a big number. That's a big number. If you're a buyer out there, you're competing. You're competing with cash in some of these cases in all price points. So it's not just limited to certain price points. So just know when you're out there, you still need to make competitive offers. Josh, I told you a story about one of our clients, one of my clients. She's not doing a loan. She's a cash buyer, but her and her family, 5 offers on a property, 3 of them were cash, and we're over $1 million. Here's what we're talking. So a lot of cash still out there, but 52% of homes closed above the asking price in June, 12% closed at the asking price, and 36% below. So just over a third getting some sort of price reduction. And that's going to go along with what we're going to look at here in a moment when we look at what's happening nationwide with regards to price cuts. Active inventory nationwide. I like to throw this in here whenever it's available. This is also through the end of June. I highlighted the ones that are kind of the anomalies, if you will, the ones that are showing not only an increase year over year, which most are, but an increase compared to where we were in 2019, so pre-pandemic, just to give you a little context there. New listings, 68,000 new listings of single-family homes. Altos believes, Mike Simonson believes that this is probably the peak. We've probably seen the peak of new listings for this year, so it'll be interesting to see how that looks going forward. New listings here with regards to June, same chart we were looking at a moment ago, but this is new listings. Again, the anomaly in this one is Jacksonville, not only up year over year, but going back to 2019 levels where everything else is still below those levels. Weekly new contracts pending, 65,000 new contracts for single family homes this week. That is 4.9% fewer than the same week in 2023. So something to note there. A lot of it has to do with rates and affordability, guys. We've talked about it. This is a new chart we haven't really shown because it hasn't been available, but this is just showing you the number of coming soons on the market. Pre-listings are actually headed down too. So if pre-listings are down, this is probably a sign that inventory is getting close to peaking because you don't have those new listings, those potential coming soon sitting on the market ready to come active in the next, here in Orange County, say 21 days or so. That's when they have to become active after that coming soon deadline. Median price of new contracts, 450,000. That's unchanged from last week and last year. New listings priced at 419, and contract prices, median price of 395, which is about 3.5% higher than last year. And our last one, again, is price cut sitting at 39%. So earlier I showed you about a third of the homes in June in Orange County were sold below the asking price. Well, this is just above a third here, showing you pretty similar numbers with some sort of price reduction. So we're seeing it all over the place. Now, Josh, we both get these charts here. Just kind of skim through them real quick. Just median days on the market by your area. Light blue, the lighter the color is, the less number of days. The darker the color is, the more number of days. You can see most of the country, especially the Northeast, where the market's still hot, days on the market are still really low. Get down to Florida, the southern Sun Belt, if you will, where, inventory is starting to grow a little bit more. You're seeing those days on the market go up. And then this is just showing the year over year change in home prices between 23 and 24 in those same markets. The red is showing, some sort of pullback in pricing, whereas the blue is showing that, you're still seeing growth in those numbers year over year. So, yeah, that's it. That's all I got, Josh. That's all I got.
That's it. And that's all.
That's it. Here we go.
Well, Jeb, you were tied up on a Zoom today, but I always find this interesting to see what happens. So that little red arrow points to where the 10-year treasury was before the Fed announcement. The knee-jerk reaction, we went from 4.1 to 4.13. So wrong direction. It looks big on the chart here, but it was actually a small move. But when the Q&A starts, we had already pretty much recovered, and then it was a straight line down. So what did Powell say that actually made the market move? Friend of the show, former guest of the show, Matt Graham, thinks that he says the market was hearing a different Powell than I was. The markets, both equities and the bond markets, moved much more favorably than what he heard coming from Powell. But here were some big takeaways. No decision on September yet. Broad sense at the Fed is we are moving closer. If the totality of data is consistent with rising confidence, September reduction would be on the table. If we were to see inflation moving down quickly, more or less in line with expectations, so we're expecting it to move down quickly, a rate cut could be on the table. The job is not done on inflation, but can afford to begin to dial back restriction in the policy rate. So the subtext there is they can cut rates and still be restrictive. In a base case, you would think policy rates would move down from here. There was a real discussion back and forth what the base case would be for moving at this meeting. So they talked about it. It was unanimous that they did not do anything today, but they did have that discussion. So focus on the highlight there, Jeb, totality of the data. What data? We've been talking about this for the better part of a year. Jobs and inflation. So we didn't really get any inflation reads this week. In 2 weeks, on the 14th of August, we get CPI. The market reacts more to CPI. The Fed looks more closely at core PCE. But I thought this was a good way of looking at it. That green line there tells you a 0.2 month over month. If every month you got 0.2 month over month, core CPI would be at 2.4. So we had 5, 6, 7 years where we were having a hard time getting to 2%. So a typical month is somewhere between 0.1 and 0.2. And they only fall in at that number because they always round. So a 0.14 is a 0.10, a 0.16 is a 0.20. So you can have a different look, but looking at this, we have, Jeb, here, we got 1, 2, 3, 4, 5 months at 0.1 in the last 12 months. We've got 1, 2 or 3 at 0.2. And then we had that little run here around the fourth quarter where it got a little bit up above that. Long way of saying we're moving in the right direction. We are likely to see core PCE. So elevated levels of prices, but a moderated rate of increase in terms of inflation. So really, more importantly, friend of the show, guest of the show, Logan Motoshami, has been all over jobs for the last year. So we're going to look real quickly at a bunch of different numbers. We saw a look at the employment cost index. This is what is the real worry of the Fed. You get a tight and hot labor market. You get inflation because employers have to pay more money to get employees. The employees have more money. They go out and spend it. It causes prices to go higher. So the employment cost index is saying that's not the case. This was ADP today and came out today. 122,000 jobs, which was less than expected, less than last month. But you can see from both NFP and ADP on this chart, they're moderating, moving in the right direction. They're not negative. We're not losing jobs, but we're not growing at the same time. This is a job opening and labor turnover survey, came out yesterday. That spike there was earlier in the year where we had got a higher rate. So in terms of, actually, this is the 10-year was spiking yesterday, and then we got the JOLTS announcement, and it kind of moderated yesterday. So it was actually, I pulled the wrong chart. I wanted to show you guys what the JOLTS basically, it's saying there are less job openings, so there are not, again, that pressure on employers to pay more to fill their job openings. So actually, here's the chart. So slightly higher than expected yesterday on JOLTS in terms of the total amount of job openings, but the job quits are moderating. The employment inflation in wages is moderating. So we're seeing what they want to see in terms of jobs. Thought this chart was really important, Jeb. It's a couple months out of date. This goes back to like February here. But this has continued on. All of the job growth that we're seeing this year is in part-time jobs. Part-time jobs are not leading to wage-based inflation. So when we say inflation is moderating, jobs are a part of that. That's likely to continue leading to lower rates of inflation. Jeb, we've been talking about this a little bit. Wanted to show this chart. So we have over time the establishment survey and the household survey. We're going to get this report on Friday, the non-farms payroll report. And there's two pieces, the establishment survey and the household survey. Well, the household survey has trended down here over the last year and a half, but we're still getting this establishment survey up high. That's because they use something called a birth-death ratio to estimate the number of businesses that are being created. And it's clearly overstating where we're at. So I threw those numbers at the bottom. The most recent figures on the QCEW, which is the quarterly something employment and wages report, showed that in the fourth quarter of last year, 344,000 jobs were created. We got 637,000 reported in the non-farm payroll survey based off of that establishment survey and that birth death ratio. So this is sort of the last thing that was worrying the Fed. We should continue to see moderation in that employment report. And you can see it from here. Again, call it moderation. This is not weakness. This is not a troubled jobs market where no employers are hiring. It's just coming back in line and not leading to wage-based inflation. So big picture, after all of that stuff today, Jeb, what does it tell us? We have a 100% chance of seeing a cut at the next meeting. So a 1/4%, 89% chance, 11% chance of a half point cut. We're up to a 78% chance of, at least if we only got the 1/4%, of getting another quarter at the next meeting. So market took from today that we're going to get a cut in September. We're likely to get one in November and another one in December. We may get a 50 basis point cut in September, but important to note, we're going to get 2 looks at non-farm payroll. We're going to get 2 looks at CPI before then. So a lot of data. Jeb, this is a chart we look at every week here. So you saw how the market reacted. That red candle is good when we're looking at bond yields. This is a 10-year treasury. We ran all the way down to the bottom of that channel. We broke through that 407 layer of resistance. So people look at this and they go, oh, this is awesome. We got the news we wanted. The market reacted. Rates are going lower now. If we look here at this next chart, the next move is likely for rates to get worse. When you have this down channel, you are more likely to stay in a channel, in a trading range, than to break out of it, which would mean you would be likely to make a run up. But if we look at that, when we hit the top, we're also likely to stay in that range. And that next move down, Jeb, if you just kind of look, when we've been in this channel, moves from top to bottom, puts us right out around the time that we would get the September meeting, where we would be getting that cut, and it brings that 385 or so in play. So yesterday to today, maybe an eighth better in interest rates. If we see this play out over the next 6-8 weeks or so, it's another 1/4% improvement in rates. So everything is looking positive, but don't take from this that we have a straight line down, that rates are going to be massively better now because the Fed is likely to cut. In terms of what does this mean? Mortgage News Daily reporting 6.7 on a conventional today, FHA and VA at 6.3. Probably looking a little bit better across the board. The important thing I like to look at here, Jeb, is all those down green arrows. Day over day, week over week, month over month, year over year. Everything is down, and we're moving on towards the 52-week lows. Last chart I wanted to show, and you feel free to comment on this one, Jeb. It showed up in the newsletter that you get last week. The only time we've seen an increase in the volume of home sales in the last 2 years was basically February of 2023 and February of 2024. Those coincided with rates dropping in 2023 down just a hair under 6% and to about 6.25% this year. So if we're at 6.625, we drop another 1/4 to 3/8, you could be in that 6.25% range. And when we did, Jeb, our forecast for this year, you thought 4.2 million in sales. And I thought we would get to this 4.5, 4.6 range based off of expecting interest rates to be lower the first half of the year. If we get rates down 6 to 6.25, I think we're going to see an increase in sales volume of that 4.3, 4.4, 4.5 million annualized sales, which is still not a hot market, but it's not like a 30-year low in terms of sales volume.
No, good stuff. So the title of today's video is where are house prices headed with lower mortgage rates? So Josh, let's take a minute here and actually talk about that question, because there's a belief out there that, hey, the Fed is going to cut rates in September, and that's automatically going to mean lower mortgage rates when they do that. You've often, if you've been here long enough, you know that I think I can speak for both of us. We believe that that's already built into the market. The fact that there's a 100% chance that the Fed is going to cut in September based on where traders are actually putting their money, the CME, the probability that Josh showed earlier, that's already baked into the cake, guys, at a 1/4% to some degree. Now, if there's a 0.5% that comes out that day, that might change the market a little bit. But I think you don't really see a huge break in mortgage rates, the break that most people want to see, until you see a break in the economy, which ultimately means employment, right? Inflation, we know, is trending lower. We've seen the numbers. You know, there's a possibility that Friday you see a huge disappointment in jobs numbers, and you could see the market move. But is it going to mean rates go from 6.7% down to 6%? No, that's not going to happen that quickly, right? It went up quickly. I think to come down, it's going to take a little bit more time, just because of how much volatility or potential volatility is out there in the market. Josh, what are your thoughts?
No, I agree with you. And the conversation will be a long one. And I think we're actually going to do 2 episodes of the podcast. One being, how low could rates go? Not that they will go, but what's the lowest they could go? You guys ask us all the time, are rates ever going to go back to 3%? Am I ever going to get a 2% rate? We're going to dig into that and say what's possible. And then we're going to do another episode of what's probable. None of us have a crystal ball, but we can look at the data as it's coming. We can think where the data is likely to go. And if it goes there, what does it mean for interest rates? And most importantly, all of you care what happens in terms of interest rates because it dictates and determines your monthly payment. But it also means, can I buy a house? Can I buy a house that I'm happy with? Or do I have to feel like, we get comments on the YouTube channel all the time, I'm not going to buy a crack house in my neighborhood. Well, okay, if rates drop and you can afford an extra $70,000, $80,000, $100,000, you're in a bigger home, you're in a better school district, you're in a safer neighborhood. Any and all of those things are important. But Jeb, the big thing that I think the market learned the hard way is with two pretty serious head fakes in 23 and 2024, the market got ahead of itself and tried to front run the Fed. The Fed was very patient, laid back, and it hasn't broke the economy yet. So you certainly can't say they were wrong. But now the markets are looking and going, okay, we might front run the Fed a little bit, but we're not going to front run them by months and try and push yields down a half, 0.75% ahead of where the Fed cuts are.
No, agreed. So with that, guys, I said it earlier, not sure what you heard and what you didn't, because I guess I was on mute using a different mic here at the house. I have COVID, guys, so I am at home. Woke up feeling like hell on Tuesday morning, just not myself. And because I got so many free testing kits, I said, why not try? And guess what? I have it. So here I am. I'm at home, basically have the flu. I feel better now. I'm not quite as nasally, but I'm still stuffy. And therefore, this is what you get. But with that, guys, where are you watching from tonight? Let us know in the chat, please. I know there's a lot of people here, 100 or so, and only a couple commenting. So it'd be helpful to know where you guys are located, because that prompts questions in our eyes when we see a market that we know is doing better and or worse than what we think other markets are doing. So maybe we can ask some questions and you can fill in some blanks for us. All right. With that, let's go and ask or answer some questions, rather. So Bits of Interest starts and says, maybe in a year, a chance to refinance from these rates. So Josh, if you're getting a loan now, you're probably taking home somewhere between 6.5% and 7% unless you're VA or FHA. What's the possibility for a refinance, within 6 months to a year?
So let's say that the market is right and the Fed cuts September, they cut November, they cut December. You have a Fed funds rate 0.75% lower than it is today. The 10-year will not follow that in lockstep. Let's say you get half of that. So you get 0.375 lower in mortgage bond yields. If we saw a little bit of compression in spreads we've been about 2.5 for 2-3 months right now. If you get that down to 2.3 or so, you could easily see a 0.5% improvement. So if we're at 6.625, 6.75, I think low sixes is reasonable by the fourth quarter. We would have to see, like you just pointed out, some significant weakening beyond expectations. So if we've been seeing unemployment tick up 0.1%, just about every month fairly consistently for the last 2, 3, 4 months. If we started getting a 0.2, 0.3 jump and we go from 4.1 unemployment to 4.7 in the next 2, 3 announcements, that's going to catch the market's attention. It's going to catch the Fed's attention. You might get some 50 basis point cuts in there. But in terms of an opportunity to refinance, always go back to our rule of thumb, 125,000 divided by your loan amount. So a $500,000 loan, you got to move 0.25%. If you have a $200,000 loan, you got to move over 0.5%. So most people, when we have a median home price above 400,000 in the US, most people, 1/4 to 1/2 is going to get them in the game. And I think we're going to see 0.5% over the next 6 months. So basically anyone who bought in the last 2 years, other than those who got real lucky and bought in February, March of each year and locked in those really low rates, is going to be able to benefit as long as you don't have a really small loan. I think the more interesting question, Jeb, is going to be when we're back here in December and January going, okay, did it play out the way we thought? And what's the next move? Do we see another 0.5% coming behind that? Or is this all we're going to get?
No, good stuff. With that, I'm going to take a minute and note, Josh mentioned earlier about some closings from people on the show. So congrats to those who have reached out and had that opportunity. Also want to, I've had the opportunity actually in the last 24 hours, found out 3 people that I referred out of state, 1 to Texas, 1 to North Carolina, and 1 to Nevada. All their offers got accepted. So they're under contract, and I was able to make that referral. They sent me emails about the agent. So if you're out there looking and you need a referral to a real estate agent, to a mortgage professional, if Josh or I can't help you directly, that link below right there will get you in touch with somebody that's on our team, somebody we trust and can guide you through that process. So don't be afraid to use that, because getting a lot of success out there and people are having success and getting offers accepted at lower prices. So good stuff. Let's go to Alma. Josh, can you use the equity in your home to pay towards the loan on the same house? If so, would it be a good fit or not? So Josh, this kind of sounds like velocity banking to some degree, the way I read it. I don't want to go into detail on that. It takes way too long to explain what it is. We can refer them to an episode. So if you're interested in velocity banking, what it is, we did an episode on the Educated Homebuyer podcast maybe 2 weeks ago. Go check it out. It's on the YouTube channel. It's on the podcast itself. Listen to it. But Josh, what's the easy answer to this?
The only way to use the equity from your home is to borrow from the equity on your home. If you have a first mortgage you want to pay down, borrowing in a second mortgage is always going to be more expensive than the first. So again, watch that video. There are some very rare circumstances for very disciplined, high wage earners that it can work, but for most people, it does not.
All right. Marco has a question here. Says, based out of Phoenix, Arizona, I've seen home prices in my area drop $15,000 to $40,000 within 3 months, and interest rates are going down as well. Would you recommend waiting till September? In no rush to buy. So what I'm going to do here is I'm actually going to pull up a little slide from someone that sends it to me. If I can find it, Josh, I'll see if I can find it.
While you're looking for it, Jeb, let me point out,
right,
you and I are going to have a conversation on Friday with John Wake of Real Estate Decoded. He's a real estate economist. He's a realtor out of the Phoenix market, and he will be able to do a great job of answering this question, giving us that information.
Well, this you can't see the whole thing here, Josh. Kind of sucks. We'll go to this one.
You got it by making us tiny.
Yeah, it is what it is. So basically, I'm gonna read directly from their report. Basically, so my buddy in Phoenix send this to me every year. And what did I do? I went in on it too tight.
Zoomed in.
What the heck did I do, man? There you go.
I
didn't know the two screens went together. Basically their note is the only green you'll notice is inventory, which is declining. It goes on to say the summer seasonality, which we haven't seen since 2019, did return. We tend to have a slower summer and a pickup in the market as we head into August and through the end of the year. They're currently sitting at 100.1, which means a balanced market. So, Josh, the summer is the slowest time in Phoenix. Why? It's hot as hell out there. It's 110 degrees and, dry and just miserable. This is when listings aren't selling, right? People are doing price reductions. Now, does that mean in 2 months prices are automatically going to shoot through the roof? It doesn't, but seasonality is part of real estate. So if you are going to wait, just keep that in mind, right? There is a chance that prices don't go down. And, you do get some more buyer demand coming back to the market. Now, with that, it's hard to gauge exactly what's going to happen. Not familiar with that market, but here's some of the data. I just thought it would be interesting to look at the data so that you know what you're looking at, right? The context of the information you're getting out there. And if you want that report, Marco, send me an email. I'll forward you John's information, and he can put you on that list where you're actually getting it and getting it directly from him if you're interested. Jack Hammer says, why would the Fed need to cut rates considering the current rates are at historical averages, Josh? So why does the Fed, what is their mandate?
Full employment and stable prices.
Right.
Which
so why would the Fed need to cut?
Core PCE at 2%. So their job is not to put interest rates at historical averages. Their job is to maintain full employment and price stability. They are concerned that by tightening the economic conditions, they have achieved price stability or are on track to achieve price stability. But now they are perceiving the risk to the employment market as being probably the greater risk. So if you look, like honestly, whenever people say average, median, anytime someone starts talking about that, just ignore it. It has nothing to do with anything. I don't care what rates average between 1950 and 1990. They have nothing to do with today. So you could get into fun questions that academics debate, like what is the neutral rate of interest? They call it R star. So you've got the neutral rate of interest plus a little buffer there is what Fed funds should be at. If you look at the real, I wish I had it, and I had the chart earlier this week, and I meant to cut it out so we would put it in the slides. But just what are real rates right now? We went from a period where we had negative real rates, where it made more sense to borrow than to save money. We are overly tight right now, and it is constricting the economy. So it's not putting gas on the flames, it's literally putting water on it. We kind of would be nice to have a period with no restrictions and no stimulus, and that is what the Fed is looking for moving forward.
All right, Marcus, I'm putting this comment up there just to let you know I got it. Your video about difficult closings and situations in the past is really informative. Please do more videos like that. So I was actually considering, I wrote down today in my notes to do a video on why I told my client to back out of the current escrow that we're in. And she did. She backed out today. So I'm going to be doing a video on why I told her to back out. Not all real estate agents just want to force you through the escrow process, because I think it's helpful to talk about it. So that'll be a video that's coming out soon. Probably as soon as I get better, I'm going to record it. So it'll come out in the next couple of weeks. And if you have suggestions, let me know. I mean, I'm always looking for suggestions on videos. After doing this for, the better part of 4 years, guys, you kind of run out of things to talk about. The creativity goes down. And so anytime somebody can give you a suggestion of something, it's very, very helpful, especially if you haven't covered it that way. So please do that. Kind of talked about that, Josh. Not going to hit that one. Actually, a lot of these are around refinancing. Just trying to. This is a good one. What would the 10-year have to be to have rates at 5%? So, Josh, if we go back and look at historical averages on the spread between the 10-year and the 30-year, where we normally sit.
So the low 1.2 to 1.3, and we've had 2 or 3 periods generally related to quantitative easing. When the government's buying a lot of bonds, then you see this real compression in the spreads. The average over the last 25 years has been about 1.7. Prior to that, it was a little bit greater. There are reasons to believe that we won't get back as low as we have been in the past. So what does that mean? Does that mean 1.7 is the low end? Does that mean 2 is the low end? Any way you cut it, 2.5, which is roughly where we're at now, a little over 2.5, is high. Still very high historically, not the 3% that we hit. But let's say it moderates some, but not as much as people are thinking. 2.25. So you want a 5% interest rate, you need a 2.75 yield on the 10-year. And the crazy thing is, Jeb, as recently as last year, we were at like 3.25. So that's not unheard of. It's unlikely to see the 10-year. We're going to see the most of the improvement at the short end of the curve, 2 years, 5 years. 10 years will improve, but not as much as the others. So do I think that's achievable and doable, a 5% interest rate? It is, but I don't think that most people want what will bring that about. A weak jobs market, weak wage growth. So people aren't buying things. You're not seeing inflation. It's a slow economy, low GDP. It's sort of that whole, you want something, but you don't want the things that cause it.
There you go. Well said. Couple questions. We got a lot of questions around refinancing, so we're going to hit them kind of as they fall into the direction we're going with this. But Nicole says, when you refinance, can you cash out what's left in the escrow account, or do you get a refund? I think the answer is both, right, Josh? You can build it into the loan in some cases, and anyway, explain it.
You're right. You can build it in the loan, but let's ask sort of the you get a refund 9 times out of 10, 98 times out of 100, you're going to get a refund, because most times it's not going back to the same servicer. So if you're going to refinance with the same servicer, which sometimes you come back to us, we can place it with the same lender, or we can place it with whoever is now servicing it we have a relationship with. You can transfer your impound from the old loan to the new loan, typically done by, hey, if you owe $200,000, but you have $2,000 in your impound account, they say you owe $198. So that way it's not you having to bring the money in on the new loan. Now, in terms of financing it, we can always add your closing costs, including your prepaid items, the amounts of taxes, insurance, to establish that new impound account. So for example, different people look at it different ways. We have a listener to the show doing a VA IRRRL in Los Angeles, and she's like, no, I don't want my loan any bigger. So she's bringing all that money in, and she knows she's going to get a refund of her impound account after closing. And that one payment that she's going to miss, she's writing that check to escrow instead of to the lender. And I have another person doing a VA IRRRL, and they were like, well, I could use some extra cash now. What can we do? Well, they got $6,500 in their impound, and their payment is like $6,000 a month. And we're going to set it up where they skip 2 of those payments. You're not saving any money. They're going to pay the interest to both of those lenders, but they're going to end up 2 $6,000 payments saved and about $6,000 back from their impound account. That limits how much they're saving each month, but they're going to get a lower interest rate, some monthly savings, and about $18,000 back. So you have a lot of options, and your lender should be walking you through that versus saying, here's the structure of your new refinance.
All right, good stuff. Because I asked, and you people, some
folks.
of you people, no, and those of you who actually did what I asked, I'm gonna repeat it because I appreciate it. But I asked earlier where you guys are watching from. So Deerfield Disc Golf coming from Dana Point, DJF from San Diego, Da Papa, Orange County, Belgium from Proud and Reels, Belgium watching this. I don't know. What time is it in Belgium? I want to know. Kel M from Texas, Dina from New York. I thought Dina lived in Florida. I'm confused. You know,
I don't know if you said it, Jed, but we've got someone in there from Olympia, Washington. I'm going to be road tripping to Olympia, Washington here in about 2 weeks. So maybe we'll have a 2-person live meetup there.
There you go. We got Tulare, Siete, number 7 is in Tulare, and Burn It Up's in Victorville, Big Burbank, Matty Skull. So Boston, here we go. We've got people actually contributing now. Thank you guys. Awesome. As more come in, I'll mention them. Let's see here. I had some questions, Josh. Let's see. It was around the buyer broker agreement. Timothy says, do you think the NAR settlement is going to hurt first-time home buyers? In some cases, it is. Yes, it is. If the seller's not willing to cooperate, it is going to hurt first-time home buyers in some cases that don't have the money to pay a fee, a compensation rather to the buyer's agent. It's that simple. And it is, you know, and I think my belief is that most sellers are going to understand that if their home isn't selling, that could be a tool to help them potentially put themselves in a better position. I think initially coming out of the gate, you're going to have some sellers that are reluctant to offer compensation just to see what happens. Different states are dealing with this in different ways. Like the state of California, for example, you can't mention any sort of compensation anywhere on the multiple listing service. So if somebody wants to find out if you're offering compensation or concessions or whatever number you want to use or language you want to use, they're going to have to call me directly to figure out if we're offering anything. And typically my response is going to be if that is, you know, your agreement with your buyer, then build it into the offer, right? Build it into the offer. But therein lies the problem with buyers, right? Because if some buyers want to structure their offer to be a stronger offer, they might say, you know what, I'm just going to pay my buyer's agent myself on the side, and I'm just going to, you know, write my offer without it. Whereas your offer might be building it in. You got 2 offers at the same price. One's paying compensation, one's not. Which one's a stronger offer? It depends, right? It's not always price, but it's going to be a factor that is thrown in there. So going back to your question, it's going to hurt some, not all, and things will normalize over time. And I'm sure there will be a meeting of the minds somewhere in the middle. But as more comes out, we're going to be talking about it. I'm doing a lot of masterminds and conference calls and everything else right now on this topic. But I know more questions are going to come. So ask them, and we'll do our best to get you the answers you need. So, all right. Let's Terry says, she owns, I'm assuming, no, maybe he, they pronoun. Can we use they? I own a house
Easy,
with a
Dwayne Wade.
If I want to convert the garage into an ADU, what loan options can you didn't get the rest of the question. So if they own a house with an attached garage and they want to convert it. Is there a loan that allows them to do that, Josh?
It's no different than cash out for anything else. So you're looking at a second mortgage. So anyone that bought prior to 2022 and has one of those wonderful interest rates, unless they have a very small loan and they need $200,000 or $300,000 for that ADU conversion, probably looking at a second mortgage. We actually do have a couple of second mortgage products now that will look at the after repaired value in case you don't have enough equity in your home, but you would after the improvements to add that second unit in terms of the ADU. So there's some options there. If you have enough equity in the home, a straight up cash out refinance, and then also the rehab loans like a 203K can be used again if you don't have the equity in the home and you have to use the after repaired value. So a number of options that would be worth talking with someone that knows what the heck they're doing. And I would say, I don't know that there's any loan officers out there that do have extensive experience with ADUs. You just want an experienced loan officer that's going to get you the right answers and is willing to do the research to find the right answers for you.
There you go. Good stuff. ZL, are realtor transactions a public record? Want to confirm they have experience with homes bought and sold. Is there a reason a realtor would hide their transaction history? So the only reason you would hide it is if you haven't done any, or if it's not extensive. I don't know that there's a full public record. If you have a Zillow profile, I think most of your listings that you've sold and helped purchase show up on there. I don't know that I know all of them don't, but the majority of them do. So Zillow could be a way to reference back and see what's on there and what's not. I know sites like realtor.com and some of these others have something similar. So that's where I'd start, but I just ask them like, hey, can you provide me a list of properties that I've sold? I actually have a map of all the properties I've sold. I could send you a Google map that drops a pinpoint on every listing I've sold. And you can see exactly with the territory that I cover.
That's fancy, Jeb. I need that plugin. You tell me how to do that. I want a map.
It's not a plugin. It takes a little bit of time, but in fact, I'll pull it up here while we're on the phone. How's that? And see if we can get it. I'll show it to you. I'll let Josh answer a question here. So let me tee Josh up, and then I'll go find it. So Josh, typically how much lower are rates for 20-year mortgages compared to a 30-year mortgage?
So they go into the same pools. So many lenders don't give you any improvement or negligible improvement. We have 60, 70 different investors, and we have a handful, 5, 6, 7 that have, I wouldn't say significantly, but definitely better pricing. If you're saying a 0.5% improvement or maybe a little bit more between a 30 and a 15, if you're lucky, you're going to get half of that on a 20-year. Maybe it's a 0.25%. Most lenders should be at least an 1/8. The aggressive ones will be a quarter better on that, but that's about as much as you're going to see on a 20-year because they still get sold into the same pools.
All right, Josh. So see if I can pull this up here. I don't know how far this list goes back, but this one has, I don't know how many it has on 356 homes. So I don't know how far that goes back, but let's share it. Invite, that's the wrong one. We're going to present a screen in a window. I'll show you this, share. And there you go.
I like that,
So,
Jeb. You got to show me what tools you're holding out. You're holding out on these good tools over there.
Yeah, so there you go. I mean, if you go out, you actually there's some that have actually no. I don't think I mapped the ones that were outside of Orange County because I'm not really using it. I mean, up north because it doesn't really help me so much. But you can kind of see that's where I have personally sold property, not Courtney on my team, not somebody else. This is Jeb. So anyway, just get an idea. But they should be able to provide you, maybe not that per se, but something that shows they have, some experience in guiding people through the process. Mina comes in with her super chat, her weekly super chat. So thank you, Mina. You are
like an addiction. Like she can't go a week without giving us $5. It doesn't complete her week.
I like it. I like it. King Figueroa says, after a buyer agent agreement expired, I asked the same agent to visit listing I saw online. Agent sent a colleague to meet me. Not happy. Can I switch a new brokers to make an offer on this property? It depends. Do you have a buyer broker agreement with that client? If you don't, then in theory, yeah, you could switch. I guess my question is, why are you upset that you didn't get that agent? Sometimes agents are busy and don't have the ability to meet everyone at the time that they want, and therefore they might send someone else out to do it. In fact, I always attend home inspections and do all of that on behalf of my clients. I couldn't this morning because I was sick. I had somebody else go, right? I would like to be there. I would like to see what the inspector said. I have the report, but it's always better to get it from the horse's mouth, so to speak. And so I wasn't able to do there. Fortunately, I let them know, right, that, hey, it's not going to be me. So maybe that's where the ball was dropped. Maybe there wasn't communication there. If you're just not happy at all, then maybe, you consider something else. If you were happy with that agent, but just not happy with that situation, maybe you have that conversation and see how it goes. It's not always a reason to jump up and run just because, of one little mishap, but you gotta make the decision for yourself, right? Can't help you there.
Jeb, we got two questions here that are similar and good. So let's throw them up here.
Yep.
Deerfield Disc Golf. If interest rates go down, is it almost guaranteed that home prices will go up? And Burn It Up says, should we prepare for more home appreciation like we did the past years with rates coming down? So some people rightfully fear that lower rates are a bad thing. We've seen appreciation moderate with the Fed meeting today. Jeb, we didn't really go deep, but we had FHFA and Case Shiller both put their numbers out this week showing solid home price appreciation, but definitely moderating, which is a relief to all of us. You can't just have 6, 7, 8% appreciation indefinitely. You hit a wall at some point. So we would like to see it moderate. Is the prospect of lower interest rates sort of guaranteeing that we're going to go back to seeing higher rates of inflation in home prices?
I mean, not necessarily, but I mean, I think you do see appreciation, right? You do see home prices. You kind of eliminate the idea that home prices are going to go down in most markets out there once you add some more demand, some fuel to the fire, so to speak. So if you're in a market that's still moving, you're not seeing any sort of price pullbacks. I don't think higher or lower mortgage rates is going to help you out any. In a market where inventory has increased back to 2019 levels, maybe lower rates just help get some of that inventory off the market. You don't necessarily see the appreciation, but inventory is not growing at the same pace. New listings aren't just flooding to the market. You're not stacking up on inventory, all of that stuff. So, hard to say. I was trying to find, Josh, while you were talking about that, and I think it was the chart the data that I sent you earlier. We get the same report every week from someone that kind of sends us different charts. And one of the charts was like, in the last 2 years, I think we've averaged 10% appreciation or something, right? Whereas the previous 3 years, it was like 40 something percent appreciation. So we've kind of normalized to some degree over the last 2 years. I think we've seen like 5.5% appreciation. More normal, right? Historical average is 4.6%, I think. Going back like 65 years.
Jeb, it's more normal, but it is not normal to see. That's the high end of normal if you're looking at a national number.
Yes.
For Southern California, we've been like 7% for like 40 years, but nationwide, that's a hot number, 5.5. And you don't generally see 2 years of a hot number coming off of the 3 hottest years ever with mortgage rates also doubling and crushing affordability. That's not normal.
No, agreed. And so I throw the question back to you. Does lower mortgage rates all of a sudden make home prices skyrocket up?
I don't think skyrocket at all. I think it absolutely puts a floor under home prices because we talk about it always goes back to supply and demand. There is always demand. A homeless person would like to buy a house in Bel Air. They can't do it if they don't have a job and a down payment. So the demand is always there, but
I have a job and a down payment. And I can't buy a house in
There you go. So it's the important part is able demand. It's not how many people want to buy the houses. It's how many people are able to qualify and purchase and buy the homes. So it increases able demand. It's going to bring a little bit of increase in supply. I think sort of a couple of things that will temper the prospects for rapid appreciation going forward is that we pulled a lot of demand forward. People that would have bought in 23, 24, 25 bought in 21, 22. So you're going to have lower amount of demand. And then just the affordability is never going to get back to where it was. We talked last week about how affordability has decreased over time. So mean reversion is to a new higher level, or at least has been for the last 40 or 50 years, unless something changes. So interest rates are going to moderate, but there is a ceiling on it. And there's also that whole idea of animal spirits. Once a market goes crazy in 2020, 2021, everyone was talking about real estate. Everyone wanted real estate. They had to work at home. They could have a home office. They could watch HGTV all day. So it was top of mind and people were doing it in mass. And I don't think that we get back to that regardless of what happens with interest rates. And if they drop to 1%, maybe you see that. But barring like record low levels of interest rates, you're not going to see that type of spike in the market.
All right, two really good questions that we've never gotten before. So I'm going to throw them both up here one after another. Norbach says, what can you do to protect the title after you get a house? So Josh, when you buy a house, one of the things that you get is a title report, and a clean title report, right? So the lender's not going to allow you to close on a home that has any liens, any encumbrances on that title that affect the I don't know, the home, right? Their insurability of the mortgage that they're putting on that home. So Josh, is there a way to protect it after the close? Or is it something that just naturally works out that it protects you anyhow?
Here's the bigger question. What are we protecting? Who's going to try and steal your home title, and how are they going to do it? They would have to monetize it in one way or another. Your home equity is an intangible thing. So if I could take Jeb's house and put the title in my name, what can I do? I could borrow a second mortgage, but it's subject to his first. I don't care if I'm a thief. And if you go back, I've done this for 29 years, and the first 5 to 10 years, it was still like the old Wild West days where there wasn't good data and ways of catching people. And if you look, what's the show on CNBC, Jeb, the criminal show that they do? Anyways, there was a great one on this dude that literally rented houses that he knew were free and clear, switched title into his name, forged documents, took out 5 mortgages on the same day at max LTVs, and got the money wired into his account, wired it over to the Caymans, and did this like 20 times. And you look and you're like, lenders now know that. You're never going to have a concurrent closing of 5 refis on a property. Could someone get title to a property? So going back to the situation, I wouldn't want the title to Jeb's home in my name because it's got a big mortgage on it. I don't want a big mortgage, and there's not a lot of equity there. So who is at risk? To me, the only people that are going to be targets for this are people that own their home free and clear, or at least have a ton of equity. So it's one of those, and don't get upset, Trumpers. Fox News, you see these commercials, like title lock, protect your title. Like, I have never seen this be an issue. There are things that startle and alarm people. You and I both know people who have lost big money through wire fraud of someone intercepting and injecting bad wire instructions, and someone wiring $100,000 or $200,000 to the wrong place. In all my years in this business, I've never heard of someone having their title stolen. Like, what are they going to do? They're going to show up and knock on your door. Hey, you got to move out. I own this house. Like, it's not an issue in a way that I'm aware of, but I'm all ears if someone can explain it to me.
Well, I actually took the conversation a completely different way. So the question, rather, a different way. How can you protect title? How can you protect, potential liens coming on your title other than like a mortgage, right? A mechanic's lien, somebody filing something and securing it against your property. Essentially, you are the protection there to some degree, right? There's insurance in the title company to make sure they're doing their due diligence. But at the end of the day, if there's something on your title that's not accurate, not true, when you go to sell it, when you go to do something, all you have to do is provide proof that that's not the case. And as long as you can provide that history of it, title more or less clears that from the title, and you're good to go. So what you don't want to do is hire contractors, do work, not pay them, do different things, and then they hire mechanics liens, and you go, oh shit, how do I get this off? That's a problem, right? You got a problem there. Or you some sort of Liz Pendens, or you get in a fight with your neighbor and you cut down their tree, and they file something and put something on your title. There, stuff like that happens. Most of the time, as long as you're not doing anything wrong, your title's not something you need to be concerned with. So that's the easy answer. John says, can a 1031, I think is what he meant, exchange be used to buy REITs on the stock market? So a 1031 is when you sell an investment property and you put it into a like kind investment. So typically you sell a residential piece of real estate and you put it into another piece of residential real estate. And the reason you do this is so you can avoid capital gains, right? You can just push the gains off until some point in the future. So Josh, can you put it into a REIT? Is that a like kind investment?
I love the creativity, but you hit on the important part, like kind. So real estate is real property. REIT is considered personal property. So you can't go real property to personal property. So you might find someone creative out there to try and pull it off for you, but the IRS is most likely going to disagree. And if they audit you, you're going to be owing them some money.
Some capital gains, and you don't want to have to pay that. Guys, it's 5:54. 5 minutes might go a little bit longer tonight if Josh has some time. If you found any value tonight, do us a favor, hit the thumbs up. And help us push the show out to other people. And depending on where you're watching from, if you haven't subscribed to the channel that you're watching, do us a favor and do that. It helps us know that you like what you're watching, so that we continue to show up every week and do this, even when we're sick. Even when we're sick, guys.
And help us make one of Jeb's special maps with just show viewers, listeners that we've helped buy houses.
Josh, that came up. That came up during when I put that up there, and that is something we have to do. We have to figure out wherever we've helped people and put it on a map. And now we show a map of, hey, these are all the places we've helped people. I think it's genius. If we can help you, that referral link below right there will get you to us.
Let's go speed round and just answer a couple quick ones here. Sarah Vicky says, when should I think about buying a house? September, January, or later?
When it's right for you, right? We can't answer that for you.
The answer never changes.
Yep. If it makes sense for you right now, then buy right now. If you're waiting because you're waiting for your credit to improve, you're waiting for the money to come in for your down payment, you're waiting for the right house because it hasn't hit the market, then wait. If the right house is down the street, you got money in the bank, you're comfortable with the monthly mortgage payment, you have a longer term time horizon, now's the right time.
There are good and valid reasons to wait, but because you're going to time the market and find an optimal entry point once you've already decided that you are able, willing, and ready to buy, that doesn't make sense.
All right. Somebody's car alarm's going off outside. My window's open, so you guys can probably hear that.
Bad part of the part of Huntington Beach.
Yeah, man, living in the hood over here. Car alarms.
Hey, Dina has a couple of good questions, and one of them here is an easy one. Does making an extra payment of at least 25% towards principal a month make a significant difference? I just ran quick numbers here. If you had a $400,000 mortgage at 6%, if you paid an extra $100 a month, which is nowhere near that payment's about $2,400. If you paid an extra $100 a month, which is more like 4 or 5% of the payment, it takes 3.5 years off of the loan. So, it's only 10% of the life of the loan, but it's a lot. So it doesn't even need to be 25%. What you need to do if you're asking yourself this question is say, how much can I afford to put to this? Do I want to lock it into home equity? Do I have another place that's more liquid that I could get a better return? So I think we covered that, Jeb, somewhere in the show of how do you prepay your mortgage and what's the ideal way. And you don't have to do it with extra principal payments. You can do it by aggressively saving somewhere else and growing that money and being able to pay it off. Gosh darn it, Jeb.
3 minutes left, guys, and he turned on
the highlight of Jeb's day, and I made it 57 minutes.
I've been trying to get this guy to take the automatic timer thing off his lights. He refuses to listen. He just says he's going to go against it, not do it. And guess what? Every single time he knocks the light on. So I have no sympathy, zero sympathy for this. Dina also has a question. Someone owns a piece of land next to me who lives in Florida. How could I go about buying the lot if I decide to? Stupid question. No, not a stupid question at all. Best thing is you must already know where they live if you know they live in Florida. But have your agent figure out the name and address, the mailing address of the person next to you. They should be able to get it from title records. And you send them a personal letter and let them know, hey, listen, if you ever decide to sell this, I'm interested. I own the house next door. I'd be interested in buying it, blah, blah, blah. Just kind of put your name out there. That's about the closest you're ever going to get to probably making it happen, and just is constantly follow up with them and just check in and just let them know that, hey, let me be the first call. And then if you're ready, fantastic. If you're not, then it might go to the market. So hopefully it's helpful.
Hey,
yep.
David wins the comment of the day. He says, if title theft isn't an imminent threat, then maybe I don't need a walk-in bathtub either.
There you go.
Similar audiences, David. Very similar audiences. The Venn diagram of walk-in bathtub owners overlaps tightly with title theft insurance owners.
Let's see. King Figueroa, another one. If a house has been on the market for 100 plus days with multiple price drops with 10% below the asking, be considered a low ball offer. Hard to say, right? Where is it priced to start from, right? If it was priced according to fair market value from the very get-go and they've had to lower it every time, which would be surprising, then yeah, it would probably be a big price drop. If it was priced significantly over the asking price and all their price drops are still above fair market value, is 10% too much? Probably not, right? It's where does that 10% throw it versus other homes that have sold in that market? And is it comparable? Is it significantly less, or is it kind of in line with where homes need to be? That's how you determine whether or not it's a massive discount compared to a reasonable offer. So kind of gauge it from there. Talk to your agent, see what they say, and that's kind of the recommendation that I would have. Josh, I didn't really fully understand what they were asking in this question here, but says, can you point me to data where affordability factors? So we talk about affordability factors. Affordability factors are interest rates, wages, home prices, right? In the net worth of individuals. I doubt income is painting the full picture from Irvine. So do you understand what they're asking directly there?
No, because affordability doesn't have any impact on net worth other than to the extent that anyone who's owned assets over the last 5 years, hard assets, appreciating assets, whether that be equities, homes, has seen rapid appreciation. So as affordability has deteriorated across the board, people who own those assets have seen the benefit of the prices and increases in their net worth. But in terms of whether something is affordable or not, generally net worth is lower when things are affordable because that means the prices of them are cheaper. But that's as best as I can do with the question.
All right. Well, guys, you know what? I completely forgot. Just popped up on my calendar. I have a flag football meeting this evening, 6 o'clock via Zoom.
You promised these people you were going to answer extra questions.
I did. We went just over an hour.
Share your COVID
just over an hour. If you'd like to stay on, Josh, you can stay on. I have to.
Deb's a super spreader, people. Be careful.
Right. You stay on. Are you staying on? Are you going to help the people out?
We'll call it a night. I got to call Sunny.
You did. You wanted to
I got to call Sunny.
All right. So, guys, if you found any value tonight, do us a favor, hit that thumbs up, subscribe to the channel if you haven't done so already. Let us know in the comments what you liked most about the show, any videos you want us to record, and we'll see you. We won't see you next week. We're actually taking next week off, guys. I'm back the following week. So there's going to be a little bit of some changes over the next week. Not in how anything runs.
I'm gonna get a GoPro and I'll do the show from a road trip in the truck.
It's going to be difficult because we're both kind of in and out, but we'll continue to update you. If you have questions, let us know. If you need help, there's a referral link below. Until next time, guys, adios.
Amigos.